Lesson L024, AI in Finance and Investing. Welcome to Lesson 24, where we explore how artificial intelligence is transforming the financial industry. Finance is one of the most data-rich domains in the world, and AI's ability to analyze vast datasets, identify patterns, and make predictions makes it a natural fit for financial applications. We will cover algorithmic trading, risk management, fraud detection, personal finance, and the regulatory landscape. Whether you are a retail investor, a financial professional, or simply interested in how technology is reshaping money, this lesson will give you a comprehensive understanding of AI in finance. Let us begin with algorithmic trading, which represents the most direct application of AI to financial markets. Algorithmic trading uses computer programs to execute trades based on predefined rules or learned patterns. The technology has been evolving since the 1980s, but modern AI has dramatically expanded its capabilities. High-frequency trading firms use AI to execute millions of trades per second, exploiting tiny price discrepancies that exist for fractions of a second. Renaissance Technologies, founded by mathematician Jim Simons, operates the most successful algorithmic trading fund in history. Its Medallion Fund has generated average annual returns of over 60% before fees since 1988, driven by AI models that identify subtle patterns in market data that human traders cannot detect. The fund is so successful that it is closed to outside investors. More accessible algorithmic trading strategies include trend following, where AI models identify momentum and asset prices and trade in the direction of the trend. Mean reversion strategies identify when asset prices have deviated significantly from historical norms and trade toward the average. Sentiment analysis uses natural language processing to analyze news articles, social media posts, and earnings call transcripts, generating trading signals from the tone and content of text. The challenge of algorithmic trading is that markets are adaptive. When a strategy becomes widely known and used, its effectiveness diminishes because other traders are exploiting the same patterns. This creates an arms race where firms invest heavily in developing proprietary models and data sources that provide an edge. The result is that most algorithmic trading profits accrue to a small number of sophisticated firms, while retail traders using simple algorithmic strategies typically underperform. Risk management is where AI may have its most significant impact on the financial industry. Financial institutions face a complex web of risks including credit risk, the risk that borrowers will default, market risk, the risk of losses from market movements, operational risk, the risk of system failures or human errors, and liquidity risk, the risk of being unable to meet short-term obligations. AI improves risk management in several ways. Credit scoring models using AI analyze hundreds of variables beyond traditional credit history, including transaction patterns, employment stability, and even social media behavior in some markets. These models can assess creditworthiness for individuals who lack traditional credit histories, potentially extending financial services to the unbanked. Zest Finance, now Zest AI, reported that its AI-based credit scoring models reduce default rates by 15 to 25% compared to traditional models while approving more borrowers. Market risk modeling has been transformed by AI. Traditional risk models like value at risk rely on historical correlations that can break down during market stress. Machine learning models can capture nonlinear relationships and regime changes that traditional models miss. JPMorgan Chase's LOXM system uses deep reinforcement learning to optimize trade execution, minimizing market impact and transaction costs while managing portfolio risk in real time. Operational risk benefits from AI through anomaly detection. AI systems monitor transaction patterns, employee behavior, and system performance to identify unusual activities that may indicate fraud, errors, or security breaches. The speed and accuracy of AI anomaly detection far exceed manual monitoring, catching problems before they escalate. Stress testing, which simulates extreme market scenarios to evaluate institutional resilience, is enhanced by AI models that can generate more realistic and diverse scenarios than traditional stress testing approaches. Fraud detection is one of the most mature and impactful applications of AI in finance. Financial fraud costs the global economy hundreds of billions of dollars annually, and traditional rule-based detection systems are increasingly ineffective against sophisticated fraud techniques. AI-based fraud detection uses machine learning models trained on millions of transactions to identify patterns associated with fraudulent activity. These models analyze transaction amount, location, timing, merchant type, device information, and behavioral patterns to assign a fraud probability score to each transaction in real time. The best systems can evaluate a transaction and decide whether to approve, decline, or flag it for review within milliseconds. PayPal processes over 1 billion transactions monthly and uses AI to detect fraud in real time. The company reported that its AI systems prevent over $10 billion in annual fraud losses. The system analyzes not just individual transactions but networks of transactions, identifying fraud rings where multiple accounts coordinate to launder money or execute coordinated scams. Credit card companies use similar systems. Mastercard's decision intelligence system uses deep learning to analyze transactions in real time, reducing false declines by 50% and increasing fraud detection by 40% compared to previous systems. False declines are a significant problem because they cost merchants an estimated $118 billion annually in lost sales, and they frustrate legitimate customers. The cat-and-mouse nature of fraud means that AI models must continuously evolve. Fraudsters adapt their techniques to evade detection, creating an ongoing adversarial dynamic. Generative adversarial networks, where one AI model generates fraudulent transactions and another detects them, are used to stress test fraud detection systems and identify vulnerabilities before fraudsters exploit them. Synthetic identity fraud, where criminals create fake identities by combining real and fabricated information, is one of the fastest growing types of financial fraud and requires AI models that can detect subtle inconsistencies across multiple data sources. Personal finance is being transformed by AI tools that make sophisticated financial advice and management accessible to everyone. Robo-advisors use AI to create and manage diversified investment portfolios based on each user's goals, risk tolerance, and time horizon. Betterment, one of the largest robo-advisors, manages over $35 billion in assets and charges a fraction of the fee of traditional financial advisors. The platform uses AI to optimize tax loss harvesting, rebalancing, and asset allocation. Studies have shown that robo-advisors produce portfolio returns comparable to human advisors at a fraction of the cost. AI-powered budgeting apps like Mint and in-app analyze spending patterns, identify opportunities for savings, and provide personalized recommendations. These tools categorize transactions automatically, track spending against budgets, and alert users to unusual charges or upcoming bills. The power of AI in personal finance lies in personalization. A human financial advisor serving 50 clients cannot possibly analyze each client's complete financial picture in real time. An AI system can monitor thousands of data points for millions of users simultaneously, identifying opportunities and risks that no human advisor could catch at scale. AI is also being applied to insurance, another financial services sector being reshaped by technology. Usage-based auto insurance, where premiums are based on actual driving behavior monitored by AI, is more accurate and fairer than traditional actuarial approaches that rely on demographic proxies. Lemonade, an AI-native insurance company, processes claims using AI and has achieved claim processing times of as little as 3 seconds, compared to the industry average of several days. Mortgage lending is being streamlined by AI that automates underwriting, income verification, and property valuation. Loan approval times that previously took weeks can now be completed in hours. The democratization of financial services through AI is one of the technology's most positive applications, making sophisticated financial management accessible to people who previously could not afford it. The regulatory landscape for AI in finance is complex and evolving rapidly. Financial regulators face the challenge of fostering innovation while protecting consumers and maintaining financial stability. In the United States, the Securities and Exchange Commission has proposed rules requiring broker-dealers and investment advisors to address conflicts of interest arising from AI models. The Federal Reserve has issued guidance on the use of AI in banking, emphasizing the importance of model risk management, explainability, and human oversight. The European Union's AI Act classifies credit scoring, insurance pricing, and access to financial services as high-risk AI applications, requiring conformity assessments, documentation, and human oversight. The Basel Committee on Banking Supervision has issued principles for the sound management of risks related to AI and machine learning in banking. Explainability is a particularly challenging regulatory requirement for AI in finance. When an AI model denies a loan application, the applicant has a legal right to know why. But deep learning models that power the most accurate credit scoring systems are notoriously difficult to interpret. Regulatory compliance requires either using more interpretable models at the cost of accuracy, or developing sophisticated explainability techniques like SHAP values that approximate the reasoning of complex models. Fair lending regulations add another layer of complexity. AI models must not discriminate based on protected characteristics such as race, gender, or age. However, AI models can exhibit bias through proxy variables even when protected characteristics are excluded from the model. Detecting and mitigating this type of indirect discrimination requires ongoing monitoring and testing. The financial industry's adoption of AI also raises questions about systemic risk. If many financial institutions use similar AI models trained on similar data, their trading decisions could become correlated, amplifying market volatility during stress events. Regulators are beginning to consider whether the concentration of AI model providers creates systemic risks that require additional oversight. As we conclude this lesson, AI is fundamentally reshaping the financial industry, from how trades are executed to how risk is managed, how fraud is detected, and how individuals manage their finances. The technology offers enormous potential for efficiency, accessibility, and accuracy, but also presents significant challenges around fairness, explainability, and systemic risk. The future of finance is not AI replacing human judgment entirely. It is AI augmenting human decision-making with capabilities that neither humans nor machines possess alone.